Get ready, because what's happening in the market right now could define what happens in 2026, and not everything is as solid as it seems. There's no single clear story, no obvious direction, but there are signals, and many of them don't add up. While the market keeps moving higher and the dominant narrative is all about growth, innovation, and opportunity, beneath the surface, something else is building, a tension that most people aren't seeing. And when markets enter this kind of zone, mistakes become expensive. Let's start with something that can't be ignored: valuations. Right now, many of the largest companies, especially those tied to artificial intelligence, are trading at historically elevated multiples. That's not an opinion, it's a fact. In many cases, prices are reflecting extremely optimistic growth expectations, far beyond what has traditionally been considered reasonable in past cycles. And that leads to an uncomfortable question. Are we seeing real growth or expectations pulled forward? Because when valuations disconnect from fundamentals, the market enters a fragile space. It doesn't mean an immediate collapse, but it does mean the margin for error gets smaller. And when that margin disappears, any disappointment gets amplified. Now, look at the second piece. The market, which is supposed to be diversified, is becoming increasingly concentrated. A small group of large technology companies represents a significant portion of the total value of major indexes like the S&P 500. This is not hidden, it's visible in the data. But what many underestimate is the risk behind it. When market performance depends on so few companies, the system becomes more fragile. Because you don't need everything to fail. You only need a few to falter. And when that happens, the impact doesn't stay contained. It spreads to index funds, diversified portfolios, and the entire system. This is not necessarily a crisis, but it is a concentration of risk. And history has shown that when risk concentrates, corrections tend to be sharper. Now add a third layer: cycles. Markets don't move in straight lines. They never have. Throughout history, even in strong bull markets, there have always been corrections, pullbacks that don't destroy the system, but reset excess. After extended periods of growth, corrections are not anomalies, they're part of the process. And this is where a dangerous narrative appears: the idea that this time is different. Every cycle has had its own version of that belief, and almost every time it ends the same way. Not because markets don't evolve, but because human behavior, expectation, euphoria, and excess remains the same. Now put it all together: high valuations, high concentration, and a market environment where many believe growth will continue without interruption. That creates a specific kind of zone. A zone where the market is not clearly overvalued, but not clearly stable either. It's not collapsing, but it's not fully solid. It's a gray zone. And inside that gray zone is where things become most interesting and most dangerous. Because within that space, two forces are acting at the same time. On one side, you have bullish arguments, the possibility of future interest rate cuts, the expectation that technological innovation will continue driving growth, and ongoing government spending injecting liquidity into the economy. These forces can support the market, even at elevated valuations. But on the other, there are limits. Valuations already pricing in too much optimism, concentration increasing fragility, and the reality that no growth is infinite. And that's where the tension builds. The market is not rising cleanly. It's being supported while pressure builds underneath. It's like a system that works, but under stress. And systems under stress don't always fail immediately. Sometimes they hold longer than expected. But when they adjust fast. What many investors don't see is that this duality creates an unstable environment, not because everything is wrong, but because everything is tightly balanced, too dependent on things going right. And when a system depends on everything going right, any mistake matters. This doesn't mean 2026 will be a crisis. It means the path towards 2026 may be filled with critical moments. Points where the market has to decide which direction to take. And in those moments, not everyone will be prepared. Some will recognize the signals,
Others will follow the dominant narrative. And as always, the difference will be who understands the full picture. Because markets don't fall for just one reason. Sometimes they fall because too many variables were aligned, and then they weren't. And that's exactly what may be forming right now. A structure where growth, liquidity, and expectations are holding the system together, while risk builds quietly in the background. The question is not whether risk exists. Risk always exists. The real question is whether you can see it. Because when the market shifts, it doesn't warn you twice. And what looks like stability today may simply be a pause before adjustment. Now, tell me, do you think the market will continue higher, driven by liquidity and technology? Or do you believe current valuations are not sustainable? Let me know in the comments. And if you want to understand what's coming before everyone else sees it, follow Critical Point.